Hello, 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 hello. Welcome to our next chapter, that is return filing and assessment procedure. I know a lot of you all have been waiting for this chapter, so let's start. I know exams are nearby. Okay, so we'll start with section 139.1. Now, what does section 139.1 talk about? 139.1 says who are the people who have to compulsory file their return. That means the return of income, that is the income tax return that we talk about, that they have to compulsory file. So that is your section 139.1. Yes, you have to remember the section number for this chapter, for this specific chapter. Please remember the section numbers. It is very important. Okay, so there are most of these items over here are actually specified under section 139.1. Some items I have taken from somewhere else, just so that you know that who all people are required to compulsory file. So first is your company and partnership firm. Now you have to remember that this also includes your LLP. So any company or partnership firm, irrespective of anything, they have to file their return of income, even if they do not have any income. Next, for all others, if before the exemption, if before you remember the capital gain exemption, we did a table, section 54, 54 GB, 54F, 54 EC, etc., etc., all the capital gain deductions. So if before all of those deductions, your GTI, your gross total income is more than your basic exemption. If before those deductions, your GTI is more than your basic exemption, then also you have to file your return of income. Otherwise, you may not. Okay. Resident and ordinary resident. Okay. We will be covering this. What is the ordinary resident? What is the resident? This we will be doing in your NR taxation. So resident and ordinary resident, who is the beneficial owner or beneficiary of any asset located outside India. If you are the beneficial owner, if you are first of all resident and ordinary resident, and you have an asset outside India whose beneficiary owner you are, in such a case, you have to compulsory file your return of income. Next, if you have deposited more than 1 crore aggregate in a current account, if you have deposited more than rupees 1 crore in total in all your current accounts, then you have to file your return of income. Next, incurred foreign travel expenditure. If you incurred foreign travel expenditure, if you went outside India and you incurred more than 2 lakhs for himself or any other person, in such a case also return is mandatory. That means either you went, or for say for example your dad went and you spent more than 2 lakh rupees for him when he was outside, then you have to file your return of income. They want to know that, boss, if you can spend 2 lakh on a foreign visit, then definitely you have some income, so please file your return of income. Okay, if your electricity expenditure is more than rupees 1 lakh, if your electricity expenditure comes to rupees more than 1 lakh, in such a case, you have to file your return. If trust income, remember we've already done trust chapter. So trust income before exemption under section 11 and 12, okay, that is the section that they get the exemption. So if the trust income is greater than the basic exemption, if before that exemption it is greater than the basic exemption that is given, I hope you all remember trust is taxable at slab rates. Okay, so if that is greater than the basic exemption, then it will be taxable. Political party before exemption under section 13A, if that is more than basic exemption, then they have to file their return. Next, hospitals, institutions, income before exemption. Okay, so I hope you are getting your trust, that is your trust, your political parties and your hospitals. If for all of these three, if before exemption their income is more than the basic exemption, which exemption am I talking about? That specific exemption that they are given. So hospital, institution before the section 10 exemption, if that is more than basic exemption, they have to file their return of income. Next, your college, universities, educational institute have to file return of income. Business trust, that is your REIT. If you remember, in the REIT we did a very small table with regards to your tax rate and TDS, etc. They have to also file your income, your return of income. Next, investment fund under section 115 UB, investment fund under section 115 UB, they also have to compulsory. Now these four items were an amendment in a previous attempt, that is sales or gross receipts. If your sales or gross receipts from business is greater than 60 lakhs in the previous year, or your gross receipt. So in case of business, if your gross receipt, that means your turnover, if that was more than 60 lakhs, okay, please remember this limit. For business it is 60 lakhs, for profession it is 10 lakhs. So if it is more than 60 lakhs in case of profession, sorry, more than 60 lakhs in case of business and more than 10 lakhs in case of profession, in such a case they have to file their return of income. Next, your TDS and TCS, your TDS and TCS in previous year, if it is more than rupees 25,000, now you have to remember it is more than or equal to. So if it is more than or equal to 25,000 in the previous year, and for senior citizens, it will be 50,000 in the previous year. If it is more than 50,000, then you have to file your return of income. And last is, if deposit in one or more saving bank account of the person in aggregate is 50 lakhs in the previous year, then in such a case filing of return is compulsory. Okay, so this is your complete list of who all people are required to file your return of income. All people are exempt. So we did for who all it is compulsory. Now we are doing for what people it is exempt. So your non-resident or your foreign company, so that is your NR or FC, having only income from investment fund. If that particular NR, if that particular foreign company has only has income from an investment fund which is set up in your IFSC, if it is set up in IFSC, if tax under section 194 LBB, if tax, that is your TDS under 194 LBB, has been remitted to your central government. So there are some conditions. That means if you have to be an NR or an FC. Then second, you should only have income from the investment fund set up in the IFSC. And third is under section 194 LBB, it should be remitted to central government. Next, if your NR or FC having only income from specified fund under section 10(4)(d), so if it is under from your specified fund, which section, that is your section 10(4)(d), then it is exempt for. Okay, mainly important is this list. This is still okay, exempt. Okay. Now next, SSC who needs to file return. So that is, what is your date? What is your date of filing of return? So any person required to furnish transfer pricing, any person required to furnish transfer pricing audit report. So transfer pricing is the next chapter that I will be uploading. So if you are required to furnish your TP report, this is called your TP report under section 92E. If they make you submit a TP report under section 92E, in such a case, your date will be 30th November. Okay, 30th November of your assessment year. So person required to furnish transfer pricing audit report under section 92E. And if it is a partnership firm that has to submit this report, then including all partners of the firm also, for all the partners of the firm also, the date will be 30th November. Okay, that is 30th November. Okay, so if TP report is 30th November, TP report is 30th November, TP report is 30th November, TP report, not the date of TP report. The people who have to file TP report, for them, the date to file return is your 30th November. For all other companies, it is your 31st October of the assessment year. Next, every person whose books are required to be audited under any law, you have to remember it is not just as per income tax, but it is as per any law. So if your books of accounts are required to be audited under any law, the date given to you will be 31st October. Every person who's partner of a firm, every person, remember, so over here it was company, over here it is person. So every person who's partner of a firm, where firm's books are audited under any law. That means, for example, if you are a partner in ABC Limited, and now ABC Limited books have to be audited. If ABC Limited books have to be audited and you are a partner in such a place, so every person who's partner of a firm, where firm's books are audited under any law, then for that person also it is 31st October. That means that particular entity whose books have to be audited. And if I wanted to make it easier, I could have written partners. So for all of them, it is your 31st October. Okay. For all other SSCs, for all other persons, it is your 31st July of the assessment year. So remember, those who are submitting TP report, it is 30th November. Next, for every other company, for all other companies, it is your 31st October. For all other person who are required to be audited under any law, plus their partners, it is 31st October. For all other SSCs, it is your 31st July. Okay, so 30th November, 31st October, and 31st July. These are your dates. Great. Now, next section is your section 139.3. 139.3 talks about your loss return. That means when you have your loss, in such a case, the return that you are filing will be called a loss return. So file return up to due date if you want to carry forward the following losses. Of course, you have heads in you have five different heads. Now, if you have a loss in some particular heads, you have to file your return on time. Only then will they allow you to carry forward this loss. So that's why it says file return up to due date. These due dates that we have studied over here, 30th November, 31st, and 31st. So these due dates, file return up to due date if you want to carry forward the following losses. What does this mean? That if you file your return after the due date, these losses we will not allow you to carry forward. These will lapse. So which are these losses? Your business loss, that is your PGBP, your speculative business loss, loss from specified businesses. Loss from specified business are your 14 businesses that have been specified. Loss in capital gains and loss from activity of owning and maintaining race horses. So if you have losses in these particular heads or these particular areas, please make sure that you file your return of income before the due date. Okay, now what are something that you have to remember? Loss can be set off even if return filed after due date, because sir, what did you say? Sir, what did you say? We will not allow you to carry forward this loss. What did I say? We will not allow you to carry forward this loss in the next year. But sir, you never said anything about setting it off in the same year. So therefore, you have to remember this, that loss can be set off even if return is filed after the due date. We will allow you to set off, but we will not allow you to carry forward. Next point that you have to remember, house property loss and unabsorbed depreciation can be carry forwarded even if return is filed late. See, salary may you can't have loss, therefore salary is not mentioned over here. IFOS may you can't have loss. Now next item that you are left is house property loss and your depreciation. So therefore, since house property loss and depreciation are not in this list, HP loss, house property loss, and unabsorbed depreciation can be carry forwarded even if you have filed the return late, that is after the due date. Next, loss allowed to be carry forwarded even if return is not filed within due date. Which losses are we talking about? We are talking about these losses. So your income tax department will allow you to carry forward these losses if and only if you prove that there was genuine hardship, that is for particular reasons. Sir, I was in the hospital. I was in the hospitals in the last 3 months. I was not able to file my return. I'm sorry. I really couldn't. It was genuine hardship. So in such a case, they have specified that if your loss, so you of course you will have to take authority. So if your loss is from 0 to 10 lakh, if it is between 0 to 10 lakhs, you have to take approval. You have to take approval of CIT or PCIT. Okay. So we will be studying these terminologies. Don't worry. You have to take authority of CIT or PCIT if it is between 0 to 10 lakhs. If it is between 10 lakh to 50 lakhs, if your loss is between 10 lakhs to 50 lakhs, in such a case, you have to take CCIT or PCCIT. Okay. So first is CIT, PCIT, then CCIT, PCCIT, CCIT, PCCIT, CCIT, PCCIT is 10 to 50 lakhs. And if it is more than 50 lakhs, then it is your CBDT. You have to take the authority that you have to take approval from a CBDT. Only then they will allow you to carry forward the loss. Okay, I hope section 139.3 is clear. Great. Now coming to section 139.4, that is your belated return. So belated return, if return is not filed within the due date, if for some particular reason you did not file the return within the due date, so you file it after the due date. So if the return is not filed within due date, it can be filed within 3 months prior to end of relevant assessment year. When does your assessment year end? Your assessment year will end at 31st March. So you have to file 3 months prior to end of relevant assessment year. That is basically nothing but your 31st December. 31st December. Okay, so 3 months prior to end of relevant assessment year or before completion of assessment. If there is any assessment going on, so you have to do it before completion of assessment. Only and only then, earlier of these, it will be considered as your belated return. If you forget someone's birthday, you wish them tomorrow, you can still wish them happy belated birthday. You wish them day after tomorrow, you can still wish them belated happy birthday. But if you wish them 4 months later, ki, oh, I forgot their happy belated birthday. It doesn't make sense now. Therefore, your belated return is 3 months. Is 3 months prior to end of relevant assessment year or before completion of assessment, whichever is earlier. No 6A deductions. There will be no 6A deductions which are income based. Okay, so 6A deductions which are income based will not be allowed since you have filed this return later. Interest under section 234A. Interest under section 234A. We've already done this. That is 1% per month or part thereof will be charged because you have filed after the due date. And late filing fees under section 234F, that is 5,000 or 10,000, that will be charged to you. Okay. Next is your section 139.5. 139.5 talks about revised return. Revised return means you have already filed one return and now you are changing it. Now you are making some changes to it. So if any error is discovered in return filed, if you notice any error, if you notice there is any error in the return that you have filed, does that mean that I cannot change it? You can change it. That is under section 139.5. That is your revised return. You can change it earlier of 3 months prior to end of relevant assessment year or before completion of assessment. Okay, so it is the same. Both these time limit for both of these are same. That is your belated return and your revised return. Therefore, I've kept them side by side. Unlimited revised returns can be filed. If I made a mistake once, I can file again. If I made a mistake in that one, I can file again. You have unlimited return. There is no limit. Can also revised after receiving intimation under section 143.1. 143.1 is your processing of return. So if you get any intimation under section 143.1, that is your system generated any arithmetical errors, etc., etc. If because of that if you have got any intimation under section 143.1, so it can still be revised even after receiving that intimation because these are errors that are apparent on record. That means it is very clearly visible that boss, you have made a mistake, I made a mistake, I'm sorry, please let me correct it. Okay, so we have done section 139.4, we have done section 139.5. Now coming to your next, that is your 139.8, that is your updated return. Now this is your amendment. So it is applicable your updated return is applicable from 1st April 2022. 1st April 2022, it can be submitted by any person whether or not furnished return. So even if you have not furnished return, you can still furnish an updated return. Time limit. Time limit, it is to be submitted at any time, within 24 months from end of the relevant assessment year. That is basically 2 years. So within 24 months, from end of relevant assessment year. If due to filing updated return, that is this return that you are filing, carry forward loss of subsequent year reduces submitted updated return for each year. For example, if as per my return originally I had only carry forwarded loss of, say for example, 50,000. Now this 50,000 I would have used next year. I would have set off this loss against my income next year, and my next year's return would also have changed. So therefore, they are saying that if instead of this 50,000, you feel that now instead of 50,000 it is 30,000 only. So now your current year's return will change, but also next year's return will change, correct? Because you will be allowed to set of less amount. So therefore, if due to filing updated return, your carry forward loss of subsequent year also falls, in such a case, submit updated return for each year. Submit updated return for each year after that. Okay, I hope this makes sense. Great. Now next is your section 140A. 140A talks about self-assessment tax. Nothing complicated. Tax to be paid before return filing. In case of shortfall of payment, if there is a shortfall of payment, for example, if your total tax liability came for 200 rupees and you paid only 170 rupees, so now there is a shortfall of 30 rupees. Now, if that 200 rupees included penalty, interest, and tax, all these three components was included. So when I am paying 170 rupees, my 170 rupees will be striked off against what? So first, it will be striked off if there is any penalty charged to me. If they have charged, if I have been charged any penalty, first of all, my payment will be set off against penalty. Then it will be set off against interest, and last it will be set off against the tax that is payable. So it is PIT, penalty, interest, tax, penalty, interest, tax, PIT. Okay, this is your order. Okay. Now 142.1 is your inquiry before assessment. So before the officers come for assessment, before the officers put an assessment on you, they will inquire, they will ask you for some information. So this is your return information and account. So for all those students who would have taken their classes from BB student, from BB sir calls it as RIA wala notice. Okay, and I feel this is a very nice way to learn it. So RIA wala notice, that is your return information and account. This is your, I'm using BB search terminology, that is RIA wala notice. RIA wala notice is section 142.1. Please remember the section number, that is very important for this chapter. 142.1 is RIA wala notice. 142.1 is RIA wala notice. Okay, now RIA wala notice is why? Because they are inquiring before they do any assessment on you, they are inquiring. So if SSC has not filed return by due date under section 139.1, remember we did the due date 31st October, 30th November, and 31st July. So if the SSC has not filed return by due date under section 139.1, then the AO shall issue notice requiring him to furnish his returns, his books of accounts, and furnish information including details of assets and liabilities. That means if the AO feel that, boss, you should have filed. If the AO feel that, boss, you should have filed your return of income, but you have not, and the due date of section 139 or section 139.1 has already passed, then in such a case he will issue your notice under section 142.1, that is your RIA wala notice. So inquiry before assessment. Okay. Next is your section 142.2a. 142.2a talks about special audit, that is the audit by the department themselves. So your AO can order SSC to get books of accounts audited. AO, that is your assessing officer, he can ask the SSC that, boss, please get your books of accounts audited, even if those books were already audited. He said that, sir, my books have already been audited. He said, no, get them audited again. So AO can order SSC to get books of accounts audited, even if already audited. Okay, this should be if instead of in. Even if already audited, this has to be submitted within 180 days. The audited books of accounts shall be submitted within 180 days. Prior approval of your CIT, CCIT, PCIT, or your PCCIT. If you remember, these were the same authorities where we required approval. Your CIT and CCIT was 0 to 10 lakhs, and your PCIT and PCCIT was from 10 lakh to 50 lakh. Remember, to carry forward those losses. Okay, so prior approval of these is required. The remuneration will be paid by the central government, because when you are getting the books of accounts audited, when you are asking the SSC to get books of accounts audited, he said that I've already paid my auditor. I've already gotten my books of accounts audited. You are asking me to audit my books of accounts. I'm not going to pay this. You want my books of accounts to be audited again. You will be the person who is paying remuneration. So therefore, remuneration to the auditor will be paid by your central government. Next, if not audited, best judgment assessment. If the SSC does not get his books of accounts audited, in such a case, what will the AO do? He will do best judgment assessment. That is, as per what he feels, how much information he has, he will do his best judgment as per that. So therefore, it is called best judgment assessment. That is, the AO himself will be doing it. So if not audited, best judgment assessment under section 144. Please remember the section numbers. I am telling you repeatedly. I have not told you to remember section numbers in any other chapter, but please, if you are doing this chapter, please learn your section numbers. So if the books are not audited, he will do best judgment assessment under section 144. Plus, there will also be a penalty of rupees 10,000. Okay. Now next is your section 143.1, that is your processing of return. Now please start linking section numbers. If you remember, we did 143.1 where? Where did we do 143.1? We did 143.1 that even if you have received a notice under section 143.1, you will still be allowed to revise your return. Remember we did here revise return section 143.1. That means even if you have received intimation under section 143.1, we will still allow you to revise the return. Okay, so now your 143.1 is your processing of return. 143.1 talks about return processed after making following adjustments. So these are checked by the system itself. If there are any arithmetical errors in the return, that means any addition, any subtraction, if the figures are not matching, these are your arithmetical errors. Next, incorrect claim is apparent in return. If it is very clearly visible that boss, this is an incorrect claim, this is not allowed. Then in such a case, your system will prompt disallowance of loss if return filed late. That means if in the year in which you received this loss, in the year which you had this loss, that year you filed the return late, remember the losses will not be allowed to be carry forwarded. So if you have claimed that loss in this current year, your system will prompt that boss, this is not allowed, you are not allowed to carry forward. So disallowance of loss if return of loss year has been filed late. Disallowance of expense or increase in income indicated in audit report not considered in return. So if your audit report has disallowed any expenditure, when you disallow any expenditure, of course your income will increase. So either disallowance of expense or increase in income which has been shown in your audit report, but while filing of return you have not considered it, that will also be prompted. And last is your disallowance of income based deductions. If there are any income based deductions which have been disallowed, those also. So all of these come under section 143.1. If there are any of these issues, your 143.1 notice will be issued. It is an intimation. It is an intimation to be given to SSC before making such adjustments. So before the AO himself makes these adjustments in your return, it is an intimation given to the SSC. Go ahead with the adjustments if no response is received within 30 days. If the SSC does not respond within 30 days of any of these adjustments, or why he is not complying with those, then in such a case these adjustments will be automatically done. Intimation to be issued within 9 months from end of financial year in which the return was filed. This intimation has to be issued within 9 months from the end of financial year in which the return was filed. Your section 144. 144 is your best judgment assessment. Where did we do best judgment assessment? Remember, pause the video and try to remember. I'm trying to interlink the section. So best judgment assessment, if you remember, we did it over here. Best judgment assessment 144 plus penalty. If the department told you to get your books of accounts audited and you did not get them audited, then section 144 best judgment assessment will be done. So best judgment assessment. When does a AO make best judgment assessment? So that is if failure to furnish under section 139.1, 139.4, 139.5, 139.1 is your return filing date. What is your section 139.4 and 139.5? 139.4 is your belated return and 139.5 is your revised return. And this was your 139.1 if you don't remember. That is filing of return of income. So 139.1, 139.4 and 139.5. If you have failed to furnish your return of income under these sections, best judgment assessment. Next, failure to comply with notice. Failure to comply with notice under section 142.1. 142.1 is your RIA wala notice. Remember, before doing an assessment, they will give you an intimation. So if failure to comply with notice, if you did not give them your books, records, or any information that they have requested, they will do your best judgment assessment as per section 144. So first is if 139.1, 139.4, 139.5, this was with regards to your return of income. If you did not file your return of income, best judgment assessment. Then next, what did we do? Next, we did that failure to comply with notice, that is your RIA wala notice. If the information, if the returns, if any account that they asked you, if you have not furnished to them, in such a case, they will do your 144, that is your best judgment assessment, BJA. Failure to comply with directions issued under section 142 2A, that is your special audit. Remember how the sections are being interlinked. That means if we had told you to do your audit, this is the same thing that we have written over here. Okay, under 142 2A we have mentioned 144. And under 144 we have mentioned 142 2A. So failure to comply with directions issued under section 142 2A, there will be your special audit. And next, failure to comply with notice under section 143 2. That means if they had issued a notice for scrutiny, if in such a case you did not comply with that direction, your best judgment assessment will happen. Now some points to remember: can only be done, your best judgment assessment can only be done if show cause notice has been given and SSC has been given opportunity to be heard. So first of all, show cause notice should be given and SSC should be given opportunity of being heard as to why best judgment assessment should not happen. Next, no refund can be issued by AO under section 144. That means by doing best judgment assessment, if the SEC has declared an income for, say, example, 15 lakhs, if the SEC himself has declared income of 15 lakhs, while doing best judgment assessment, if the AO comes to a figure of, say, for example, 12 lakhs, in such a case, he cannot reduce the income. So therefore, no refund can be issued. That means if under best judgment assessment, if the income comes less, you have to ignore it. No refund will be issued. Order to be passed within 9 months from the end of assessment year. Okay, so over here also it is 9 months. I will give you a small trick. If during the exam you do not remember where is what, 9, possible you will get it correct. Okay, assessment under section 143 3 and 144 shall be made in a faceless manner. Okay, next part is your reference to your DRP, that is your dispute resolution professional. 144C. 144C talks about reference to your dispute resolution professional. So now, in such a case, when your foreign currency, when your foreign company, when your foreign company or non-resident, in whose case the AO wants to make variation unfavorable for SSC. So if it is your foreign company or it is your non-resident, if your assessing officer wants to make any changes, if the assessing officer wants to make any variations which are unfavorable to the SSC, that means which are increasing his income, or say for example which are not giving him any deductions, or for other SSCs in whose case variation in total income arises due to order of TPO under section 92 CA. So if it is due to the order of your transfer pricing officer, so for other SSCs in whose case variation in total income arises due to order of TPO. So what you have to remember is TPO is between transfer pricing is of course between your associated enterprises, and this is your, so for all your foreign companies and your NR, any unfavorable variation. For all others, only if the variation is due to order of your TPO under section 92A, then this section will be applicable, that is your section 144C. AO to follow below process for above cases. Your assessing officer will follow this case. So first of all, forward a draft order copy to the SSC. Now your SSC will be given 30 days to either accept or object. That is, if he does not agree with it, he will be given 30 days from the date when order copy has been forwarded to him. If your SSC accepts, then within 1 month from end of month, acceptance shall be received. 1 month from the end of month, acceptance shall be received, and AO will pass the final order. Okay, now what if the SSC objects? What if the SSC objects? Then it is 9 months. If it is, then it will be 9 months from the end of month. EOM is your end of month. 9 months from end of month, draft order forwarded to SSC. That because the SSC has objected, so now this is a draft order. DRP will issue directions to AO. Within 1 month from end of month, the directions shall be received. Okay, so 1 month, 9 months and 1 month. So within 1 month from end of month, the direction shall be received, and then AO shall pass final order. SSC can file appeal to your ITAT if he is not satisfied. Okay, I hope this is clear to you. So first of all, SSC will be given 30 days. SSC can either accept or object. If SSC accepts, this shall be given 1 month from end of month from acceptance has been received. AO will pass final order. That means whenever the acceptance is received, 1 month from the end of month, AO will pass the final order. If SSC objects, 9 months from end of month, draft order will be forwarded to SSC. DRP will issue directions. Then 1 month from end of month from when directions were received, AO will pass final order. That means for example, if the directions were issued, say for example on 7th April, if the directions were issued on 7th April, what does it say? 1 month from end of month. What is the end of month for April? It is 30th April. 1 month, that is 30th April, will become 31st May. January, February, March, April, May. Correct? May has 31 days. So AO has to pass his order by 31st May. Okay, I hope therefore it is 1 month from end of month. AO will pass final order and SSC can file appeal to your ITAT if he is not satisfied. Okay. Next is your section 145.3, that is discretionary best judgment assessment. That is when will they do discretionary best judgment assessment? If you remember, best judgment assessment was section 144 and now we are doing 145.3, that is your discretionary. So if the if the AO is not satisfied about completeness or correctness of the books of accounts, or correct method of accounting was not regularly followed by SSC, that means sometimes it has been some method, sometimes it has been another method, and your ICDS notified by government has not been followed. I put a separate video on ICDS also, very quick short video of 5 to 10 minutes. So if your ICDS notified by government was not followed, in such a case, the AO will do discretionary, that is on his own, best judgment assessment under section 145.3. Great. Now next is section 127, that is transfer, power to transfer cases. So your CCIT and your CIT can transfer case. CCIT and CIT can transfer case from AO to subordinate AO after giving reasonable opportunity of being heard to SSC. No reasonable opportunity of being heard if transferred to AO within the same city or town. So if it is transferred to another AO but it is within the same city or town, then this ROBA need not be given. Next is section 133, that is power to call for information. So your income tax authority can call information from any person to furnish any information. Power cannot be exercised by authority below the rank of CIT, DIT. So since the long time we are talking about CIT, DIT, CCIT, CIT, PCCIT, DGIT, whatever, etc., we are talking. So what are these? So this is your authority matrix that I've made. So first of all, it starts with your CBDT. CBDT has basically two wings under them. First is your assessment wing and second is your investigation wing. Now those in these blue boxes are called your IT authority. So whenever we say IT authority, we are referring to these people. Okay, so your assessment wing is your principal chief commissioner of income tax, that is your PCCIT, your chief commissioner of income tax, that is your CCIT. Then your CIT is your commissioner of income tax and PCIT is principal commissioner of income tax. Okay, over here also principal director of general of IT, director general of IT, principal director of IT, director of IT, PDIT, DIT. Okay, over here also it is the same: CCIT, PCCIT, DGIT, PDGIT, CIT, PCIT, DIT, PDIT. Okay, your additional CIT or joint commissioner is your JSC. Assistant commissioner, deputy commissioner will be your ACDC, and income tax officer is your ITO. Over here also same, it is JD, AD and DD. Tax recovery officer is your TRO and inspector of income tax. So these people are your most powerful. We are going in a descending order. So these are your most powerful. These are comparatively less powerful. And this is the least powerful. Okay, so this is the downward power. Great. Your income tax authority, your IT authority can impound books of account for maximum 15 working days. They can only impound, that means actually physically take the books of accounts only for maximum 15 working days. 133B talks about power to collect information. So your IT authority, therefore, look, everywhere IT authority is being used, therefore it was necessary to understand what your IT authority, who all people are included in your IT authority. So all people in this range will be your IT authority. Okay. IT authority, this is a very important section. Please remember, that is your section 133A, that is your power to survey. Your income tax authority may enter any place of business during business hours. Place of business, if you are entering, it can only be done during business hours. If say for example it is a call center that works from night from 12 to morning 7 a.m., then business hours the income tax authority can only enter between 12 to 7 because those are the business hours. And if it is any other place, it has to be done after sunrise but before sunset. What you have to remember, this time limit is only for entering, it is not for exiting. So they have to enter after they have after sunrise but before sunset. Okay, so any other place of business after sunrise before sunset, and for other place of business it will be your during business hours. After approval of your PDGIT, DGIT, PCCIT, CCIT, PDGIT, DGIT. Okay, so let's see which people are these. PDGIT, DGIT, PCCIT, and CIT who are entering your IT authority. Does this matrix now make sense? Your income tax authority, all of these people I told you are your income tax authority. Now of course they will take approval of these people. Okay, so they have to take approval of these people before entering. Now what is the power, what all powers do they have? That is inspect books of accounts, place marks of identification of books of accounts, any marking that they want to do they can, record statement of any person. Next, verify cash and other valuables, impound books of accounts, maximum 15 days we have studied, make inventory of any cash or stock, that means they can count it. Now what you have to remember, if income tax authority is of the opinion that it is necessary to do survey at any function, that means it is not your place of business. For example, they are getting married and they will say, I want to do survey right now. So if it is at any function, they can only do survey after ceremony or function has concluded. Now imagine the bride and the groom, they are taking the saat fere, they are taking the 7 rounds, and during the fourth fare only the income tax authorities enter. So now that is not okay, because you have to respect their personal ceremonies. So if income tax authority is of the opinion that it is necessary to do survey at any function, can only do survey after the ceremony or function has concluded. That means after it has gotten over, only and only then you can do the survey. You can still enter, but only after the ceremony has been completed. Okay. Next is your TDS TCS survey. So your income tax authority, what you have to remember are these they ask you in MCQs. That is what time can they enter. So you have to remember that place of business during business hours, any other after sunrise but before sunset. Okay. For TDS TCS survey, income tax authority may enter place of business. Remember over here, even for place of business, it is after sunrise but before sunset. Over there, the place of business, for place of business, it was during business hours. Okay. So IT authority may enter place of business after sunrise but before sunset. Can inspect books and ask for information, but cannot impound books, make inventory of cash or stock. So that means this is not allowed. This is not allowed under TDS TCS survey. Okay. So you will not be allowed to impound books or make any inventory of any stock or cash. Great. Now coming to our next part, that is your search seizure, which you also call as raid. So search and seizure, that is your section 132. So who can authorize your search? That is issue search warrant. Which authority will issue your search warrant? PCCIT, CCIT, PDGIT, and DGIT. If you remember the authority, these are your top people. That is, these both we have read over there. Okay, next let's see who are there. PCIT, CIT, PDIT, and DIT. These people also. Okay, next. Additional CIT or your DIT. That means only these. So over here, let's make 2 tick marks so that both of these we know are included. Over here also we'll make 2 tick marks. And we did only additional CIT and additional DIT. Then what did we do? JC and JD. So these are your joint commissioner and joint director. Okay, so only these people basically, who are the people who can do who can give the authority, who can issue search warrant, search and seizure warrant are these people. This is where the line is drawn. Great. So please try to remember as and as you are watching the video, so that it will be, you don't have a load to remember. Okay, so we, all of these people are the people who can issue the authority. Okay, next is when. So if your income tax authority has reasons to believe that the person to whom notice under section 142(1), which is the section 142(1) notice. So 142(1), remember, Riya wala notice. So if they are under opinion that the person to whom we have issued your section 142(1) notice, that is your Riya wala notice, or someone under section 133(1) might be issued to produce books of accounts, they will fail or will not produce. So either they will not, if they are of the opinion, if they are of the opinion that even though we have issued them the notice, they will not, or any person in possession of undisclosed money or jewelry. If you remember, there was a movie Raid. Okay, so for all of this, in these instances, search and seizure, that is your raid, will be conducted. Now, what is the power? Enter and search any premise vessel where you suspect that books or money are kept. Of course, your this point was related to books, and this is with regards to money. So enter and search any premise or vessel where you suspect that books or money are kept. Break locks of door, locker. Search any person about to go in or go out of the premise or vessel. Require employee to provide password if books of accounts are in electronic form. These books of accounts, documents, money, jewelry. What you have to remember is stock cannot be seized. All of these items can be seized, your books of account, documents, but stock, that is your business's stock, cannot be seized. SEC to make application within 30 days from end of month in which asset has been seized to explain nature and source of acquiring such assets. So if your asset has been seized, you have to show them that both these are the sources of income that I have used. So 30 days from end of month in which asset seized to explain nature and source of acquiring such asset. If AO is satisfied, asset can be released within 120 days from date of conclusion of search under section 132 with your CCIT or your CIT approval. Next, if authorized officer has no jurisdiction over the person searched, asset seized to be handed over to AO having jurisdiction within 30 days from when the search was completed. That means if the assessing officer did not have jurisdiction, he will still do it. However, these assets shall be handed over to the AO who has jurisdiction within 60 days. Next, your books of accounts and documents shall be released within 30 days from date of completion of assessment under section 147. So this has to be released within 30 days. CCIT, CIT approval required to retain beyond this period. So if you want to retain it for a period more than 30 days, in such a case, your CCIT or your CIT approval is required. Next is your income escaping assessment, that is your section 147. 147 is your income escaping assessment, that is reopening of cases. So if any income chargeable to tax in the hands of SSC has escaped assessment for any assessment year, that means this income has not been assessed, AO may assess or reassess such income. He will also be allowed to include any other income which came across after initiating the assessment. For example, if the AO knew that this income has not been included, but as he dig deeper, he also knew that all of these incomes have also not been included. In such a case, he will be allowed to include those income also, even though the reason for starting the assessment was another income. Before starting assessment under section 147, you have to give notice under section 148. Time limit to issue notice under section 148 is 3 years and 10 years, 3 years and 10 years, 3 years and 10 years. It will maximum 3 years to have elapsed from the end of the relevant assessment year. Whichever relevant assessment year the AO feel that the income has escaped assessment, 3 years. He will have to do it maximum 3 years. However, if the AO has evidence that the income escaped is greater than 50 lakhs of that year, instead of 3 years will become 10 years. Okay. So usually it is 3 years. If the AO feels that income has escaped assessment, it is 3 years, but it will be 10 years. If the AO feels that the income that has escaped assessment is more than 50 lakhs. In response to notice under section 148, So in response to notice under section 148, SSC is required to file a return of income for that year. Again, that means even if the SSC has already filed the return, he still has to file his return income again. 148A talks about needs to be complied before issuing notice under section 148. So 140, what are the things that you have to comply before? So first of all, before doing 147, you have to issue notice under section 148. Now, before issuing notice under section 148, you have to comply with section 148A. 148A talks about you have to conduct inquiry to ensure that income has escaped assessment. This inquiry has to be conducted that to ensure that income has actually escaped assessment. You have to provide reasonable opportunity of being heard to SSC as to why notice under section 148 shall not be issued, and decide as per reply of SSC within 1 month from end of month of reply received. That means 1 month from end of month in which the SSC has replied, you have to decide that what should I conduct? Should I issue notice under section 148 or not? So to do 147, you have to comply with 148. 148 is the notice. To do 148, you have to comply with 148A. Now 148A is not applicable in some case. That is notice. Notice under section 148 can be issued within section 1 without the compliance of section 148A. Notice under section 148 can be issued without 148A compliance. If it is a little heavy for you, pause the video, but we are going in a flow. For 147, that is for income escaping assessment, 3 years and 10 years. For income escaping assessment, you first have to issue notice under section 148. But to issue notice under section 148, you have to comply. You have to comply with 148A. 148A had 3 conditions. Now, in some cases, 148A need not be complied. 148A need not be complied. That means notice can be issued directly under section 148. If search initiated under section 132, if the search has been initiated under section 132, 148A compliance need not be required. Or the AO is satisfied that the books of accounts or the assets seized under section 132 belong to the SSC. So in these cases, 148A need not be complied. Now next is your section 148B. 148B talks about if search is initiated under section 132. If search is initiated under section 132 or survey under section 133A, other than your TDS or TCS survey, if it is other than your TDS or TCS survey, then the assessment or reassessment shall not be made by AO below the rank of your JC, that is your Joint Commissioner. 150 talks about unlimited time limit to issue notice under section 148. There is unlimited time. If reassessment is to be done due to order passed by your CIT, ITAT, High Court, Supreme Court under section 263 or 264, in such a case, there is unlimited time limit to issue notice under section 148. Only and only under these cases. Proceedings can be dropped by AO if SSC can satisfy him that no tax liability will arise even after taking into account the income escapement and he has not gone in appeal or revision. That means if the proceedings have already been begun, but the SSC shows him that even if you include this income, my tax liability will not increase. That means that no tax liability will arise even after taking into account the income that is escaped, and this person has not appealed. In such a case, the proceedings will be dropped. Time limit to complete assessment under section 148 is 12 months from the end of financial year in which notice under section 148 has been served. This is your time limit to complete assessment, that is to complete 147, because the notice is issued under 148 but the assessment is 147. So 12 months from the end of financial year in which the notice has been served. AO cannot invoke section 147 on basis of rumors or gossip. That means he should have proper evidence that the income has actually escaped. Just on basis of rumors or gossip or his gut feeling, he cannot invoke section 147. SSC required to file return of income under section 148. If not filed, AO will complete assessment under section 147. Return so filed cannot be revised. As we had studied your revised return, your belated return, section 139.5. 139.4 was your belated return, 139.5 was your revised return. So return so filed under this section cannot be revised. It is once and for all. Expenses not claimed in original assessment cannot be claimed in reassessment proceedings under section 147. Any expenses that you had forgot or you had not claimed in the original, you still cannot claim those. Only and only we are only interested, the income tax department is only interested by increasing your income. They do not want to give you any extra deductions. But expenses pertaining to income which has escaped assessment can be claimed. That means any income which was not assessed itself. So now you are assessing that income. So any expense related to that income will be allowed. But any expense related to income which was already been assessed, those will not be allowed. Okay. So make sure you understand those. Expenses pertaining to income which has escaped assessment can be claimed. Okay. AO shall serve notice under section 143(2) within 3 months from end of financial year in which return was filed under section 148. Otherwise, proceedings under section 147 are valid. So this has to be done within 3 months. Okay, now we have completed our chapter. Just this is our last part. Don't worry. 154 talks about rectification of mistakes. So your income tax authority can rectify mistakes. So either suo moto or on application. Suo moto means by themselves, which is apparent or record. That means which is very easily visible that yeah, boss, this is a genuine mistake. This is, they are not trying to hide something. It is just a mistake. So any order passed by authority, intimation under section 143(1) or your TDS TCS intimation under section 200A or 206 CB1. If rectification is done suo moto, this rectify within 4 years from end of financial year in which the order with mistake was passed. So if there was a mistake in the order itself, 4 years from the end of financial year in which the order was passed. If rectification done on application, if it is done on application, rectify within 6 months from end of month in which application has been received. In whichever month you have received the application, do the end of month, 30th or 31st. Then 6 months calculate, that is with the time limit within which the rectification should be done. And last is the section 156. 156 talks about your demand notice. So if any interest or penalty is payable, AO shall serve demand notice. That means income tax authority, income tax department is demanding money from you. So if any interest or penalty is payable, AO shall serve demand notice specifying the payment. SEC to pay within 30 days from receipt of notice. That means whenever he gets the notice, the payment shall be made within 30 days, and it will be noted that the SEC has paid. And with this, we are done with this chapter. I hope I was able to make it easy for you, and I will see you in the next one.